Hi everyone, it's Jack about another video. Today I'm going to be doing a video on Facebook or Meta platforms. Going to be using those interchangeably, so don't ding me too much if I keep saying Facebook. Meta platform stock has been an absolute disaster pretty much since the name change from Facebook. The biggest single day market cap loss ever on Q4 results day, and a drop that has not stopped since there. They lost around $200 billion in market cap on that day. Since the highs of September 2021, the market cap has almost halved, an absolutely staggering loss in pure dollar terms of around $500 billion. Market cap today is about $525 billion. I want to try and establish whether I think it's undervalued. I'm going to take a look at the most recent financial reports, the Q4 reports that made it drop so much. Take a look at the balance sheet, into profitability metrics, some valuation, have a look at some analyst expectations and do a DCF, and then summarise what I think of the business going forward. Appreciate you if you like and subscribe if you're enjoying the content. Jumping straight into that report, one of the main concerns many investors have is that the core Facebook platform is in decline. To me, this is purely anecdotal as far as I'm concerned. A lot of young people mention how infrequently they use Facebook nowadays, but purely anecdotal in my opinion. Daily active users was just shy of the previous quarter, basically the same at 1.929 billion. Unlike many social media companies, they have not suffered any real losses from any potential pandemic gains. See Pinterest, they've lost significantly. Facebook does not seem to have lost any at all. It's just the Facebook platform. The Facebook family of apps, including Instagram and WhatsApp, is again up significantly in daily active users. The company in the last 2 years has grown around 300 million users, which at this scale is absolutely terrific. The platform remains really sticky and people continue to use it every day, despite how outdated it is becoming in now other social media apps, particularly with the rise of TikTok, which a lot of people are concerned about. People are still finding time in the day to use Facebook, albeit perhaps an older audience. Meanwhile, WhatsApp and Instagram put in very strong numbers in their own right, so I don't think this is anything to be concerned about. The Facebook family of apps is still consistently growing users, even though the rates of growth are coming down slightly. Taking a look at how they monetize those users, the metric you'll see often is average revenue per user. Key statistic for Meta in my opinion, and a key statistic for all social media companies. This is reported from the company as an average of the family of apps. Instagram and WhatsApp are relatively new to monetization and nowhere near the numbers Facebook pulls in, so Facebook is severely subsidizing this average revenue and the other two are pulling it down significantly. So it's clearly averaged down across the family. Across all apps, average revenue per person or per user is $9.39, which continues to be an increase at a solid rate year over year, with very few declines aside from the obvious seasonality and cyclicality that is to be expected with advertising businesses. You can see Q4 2020 was an exceptionally large number, Q4 2019 exceptionally large number, because this typical period. Q4 2020 was the election period, Q4 2019 is when is Christmas period. These are expected to be large numbers, but consistently this number is increasing and at a decent rate. Instagram and WhatsApp again, relatively early days of monetization. Instagram a bit more, but WhatsApp is barely monetized at all. Instagram is growing its monetization at a great rate. Again, nothing to be concerned about here. There's a lot of room for growth in these metrics. Overall, revenue continues to grow at a pretty strong rate, particularly for this scale. Importantly, the revenue is increasing across all geographies. Just like to emphasise the scale, in the most recent quarter did $33.67 billion purely for the quarter. That is an enormous amount of money, especially considering that this is a $525 billion company right now. You can see that the valuation is really starting to come into check. US and Canada is clearly the largest and most mature market, but all the other markets are starting to make more significant contributions. All of them are steadily going up, with a few mixed bag quarters in between. You can see, as I mentioned, Q4 2020 was a significantly larger number than the quarter afterwards, but this happens. There is some seasonality and cyclicality. From Q1 2020 to Q4 2021, quarterly revenue for Europe nearly doubled. Really impressive growth considering Facebook is not exactly new in Europe. It's already a massive scale here. Incredible numbers. And the trend, they're increasing monetization across all platforms in all geographies, and they're only trending up. I'm really impressed with this. These revenue and user growth concerns were mostly after the drop, when everyone wants to pile on, say how bad the company is, how right they were about it, how bearish they are. In my opinion, this is massively overblown. The stock dropped on weak guidance and a bit of cash burn and some net reduction in net income. Cash burn is a bit concerning right now. Cash set position is still strong with a ratio of 3.46, but cash burn is undoubtedly increasing as they push to create the metaverse offering. They're hiring a lot more people, they're spending their cash, which I'm not completely against. Growth requires cash spend, and I'm not completely against that, but it is increasing at a very large rate. Cash reserves are now $48 billion at the end of 2021, down from $62 billion a year ago, and debt rose slightly from $10 billion to $13 billion. If this sort of cash burn continues, this will become concerning, but the cash set position of 3.46 is a very free cash flow intensive business. I think that they're going to be just fine. Facebook's return on invested capital is excellent at over 40%, so I trust whatever capital they're investing. I absolutely trust that they're doing the right thing with this. A 40% return on invested capital is an absolutely incredible number. Debt to EBITDA again ratio is again 0.25, indicating that any debt they're taking on is fairly well covered. It's been assigned an Altman score of 10.02, indicating that it's safe from financial default and not an immediate risk. All this indicates to me that this is an almost fortress-like balance sheet backed up by absolutely fantastic margins, some of the best you'll see in any business. Nearly 40% operating margin, 33% net margin, both absolutely ridiculous numbers for a company of this scale. Excellent numbers for the industry, obviously, and excellent numbers versus Facebook's history, although not the best they've ever recorded. Return on equity percentage of nearly 30%, again, absolutely excellent. Even for this industry, I would expect maybe 20%, between 20 and 20%. I'd be happy with. 30% is outstanding. Return on assets to 24%, again, absolutely outstanding. I would expect somewhere between 5 and 15% for a business of this kind. 24% is a brilliant number. All of these metrics are absolutely fantastic, and is why Facebook is able to generate such a large amount of cash, is so free cash flow positive, and why it can afford to take on a little bit of debt and spend some cash to grow is because its margins are ridiculous and continue to be ridiculous. So clearly this is the most important part, is the valuation. This is all that's really changed in my opinion. PE ratio is now 14 and forward PE of 15, both below the current S&P 500 averages, probably for the first time in Facebook's history. Of course, this company is no longer the growth behemoth it once was, but current expectations are predicting a decline in my opinion. This is clearly not a company in decline as I've established. This is a premium company that trades traditionally at PEs of 20 and above. A PEG ratio of 0.52 indicates a screaming buy in my opinion. Under 1 I think will be an absolute bargain. Price free cash of 14 is again dirt cheap. You can see from the right hand side, pretty much every metric is the cheapest it's been in Facebook's history or in recent history. We're now at 2018 levels for the stock price. I think fear and selling is way overblown. This is one of the most oversold stocks I've ever seen. To pick up a company of Facebook's quality for a P ratio of 14 is absolutely absurd. I think people should be loading up at these prices, but we need to dig a bit deeper to figure out if this is completely fair value right now. While I believe that the valuation is basically predicting a flat growth, possibly a decline, analysts are calling for continued strong revenue and earnings per share growth. The current valuation of this stock is far below what you would expect for a company that is expected to grow its future revenue and future earnings per share growth rate of 14%-ish. By 2024, earnings per share is predicted to be $16, $17.19 without NRI. This would be a current AP of around 11. This stock is continuing. Any further multiple contraction, any stock price decline will be getting towards ridiculous levels of valuation in my opinion, based on the future of this company. Finally, I want to look at Facebook's intrinsic valuations. I've done a discounted cash flow analysis. I've used a 10% growth rate in free cash flow over the next 10 years. Again, for me, this is a very conservative growth rate, far below the 10-year growth rate of 45%, which is obviously unrealistic now because it's not the size it was 10 years ago, but even significantly below the 5-year rate of 23.9%, and even against the average analyst expectations around 14%. Using this with an 8% discount rate gives a fair value of $286. That is compared to a present day stock price of $192, possibly dirt cheap. 50% upside from the current price using what I feel are relatively conservative estimates. You're free to disagree with that, but I believe these are sensible numbers. And for me, this is just a screaming buy at these prices. In the near term, I expect the stock price to continue to fall slightly. I think it's a sensible time to dollar cost average. I think there's wider fear in the market, and it's really impossible to sell the price action of any stock going forward, really. I think as far as the business is concerned, revenue continues to grow at a nice rate. Earnings per share growth 14% is expected for the next few years. I think using my relatively conservative calculations of 10% free cash flow growth, 50% upside from the current price by DCF, to get an absolute fair value, would only need 4% free cash flow growth for the next 10 years. That would give exactly fair value. I think Facebook can far outstrip this in the future. I believe none of these factors factor in the potential that Meta could be a major player in the metaverse, potentially huge market, but crucially, it does not need this to be successful and primarily be a fantastic investment and produce fantastic returns. I think this is a really attractive entry point to buy a hugely successful company, one that if it disappeared today, people would absolutely notice, that has incredible margins, that is trading at a significant discount to its fair value, and I'm going to be dollar cost averaging in the future. In the near future, over the next few months, because I believe, not because this is my absolute favourite business, but I just think this is now absolute bargain territory for a company that will absolutely be bigger in the next 5 to 10 years. So with that being said, none of this is financial advice, of course. If you want financial advice, you should speak to a registered financial advisor and do your own research and due diligence, do your own stock analysis. If you're enjoying the video, please like and subscribe. I'll see you again next time.